Most people pay federal taxes on every dollar they earn throughout their lives. When they pass away, the government performs a final tally on whatever wealth remains. If you leave behind a home or a retirement account, your heirs often liquidate those assets to divide the inheritance. The moment they sell, the IRS claims a percentage of that value. Billionaires operate under a different set of rules. For them, passing away functions as a legal mechanism to delete tax liability before it can ever be collected. This is the third and final stage of the wealth management strategy known as buy, borrow, die. This legal architecture ensures that the largest fortunes in the country are preserved and passed on without ever being subject to the standard costs of the American tax system. This diagram represents a simple asset investment. We'll call it a golden egg. You buy it for exactly $10. Over your lifetime, you build a massive company. Your $10 egg appreciates until it is worth $10 billion in stock. To spend that money, you have to sell the stock. But cashing out triggers a 20% capital gains tax on that growth. That means handing the IRS roughly $2 billion. You want to keep the money, so you don't sell. Instead, you live off low-interest loans secured against the egg and hold on to the actual asset until you die. Usually, if someone sells an asset right before they pass away, they still owe that massive capital gains tax. But if you hold the asset until death, your wealth gets an immediate respawn. This happens because of a specific clause in the tax code called the step-up in basis. Here is the math. The moment you pass away, the IRS legally updates the original purchase price of your asset. They change your $10 starting line to $10 billion. The entire history of your profit growth is legally erased. According to the government, that $9.9 billion in capital gains never occurred. Because the official starting price is now $10 billion, your heirs can sell the stock the very next day for $10 billion. Their taxable profit on that sale is exactly zero. The step-up in basis transforms decades of untaxed wealth growth into liquid cash for the next generation. Zoom out, and you see the macroeconomic reality. This specific accounting mechanism is the primary reason massive fortunes can pass completely intact to heirs across generations. This is the Internal Revenue Service building. While billions of dollars in taxable gains legally disappear from its ledgers, the federal budget is funded by the salaries of average wage earners, whose income is taxed directly out of their paychecks. There is one intended hurdle left, the estate tax, a 40% levy on fortunes over a certain threshold. Lawmakers designed this tax to catch extreme wealth precisely when billionaires die. But if the step-up in basis already shields these assets from capital gains taxes, how do billionaires bypass a second 40% tax on their remaining wealth? They deploy a secondary exploit. By weaponizing philanthropy through opaque financial instruments known as charitable remainder trusts, they ensure their heirs keep the fortune. We will break down exactly how that works in the next episode.